Okay, ladies and gentlemen, welcome to the Macro Ace live stream of the FOMC with your host, Tony. Hopefully you can see my screen okay and everything's all good and clear for you. If it isn't, do let me know and I'll make any adjustments to it where need be. All right, so the FOMC. Oh, apologies if you couldn't hear me. Okay, let's go back a little bit. So as said, they meet roughly every 6 weeks over 2 days. Hopefully you guys should be able to hear me now. Should be. There we go. Is my voice coming through? Okay, voice is working fine. Good. All right, so as I was saying, I set policy and the federal fund target range. Current range is 0.25 to 0.50, the high end being 0.5, which is where the current rate is at the moment and what traders tend to focus on. And then if we keep going on, so why is it important? So the reason why it's important is because it causes a lot of volatility and volatile moves in the markets and affects the wider economy as well. So that's one of the reasons why it's quite a key release to focus on, and for everyone really in general, not only for the US but globally as well. And of course, when you do have the Fed statement that's released alongside it, there could be differentiation in views where you could have a hike, but you could have dovish comments, i.e. where the central bank could be thinking that maybe looser monetary policy might be needed, or maybe that there isn't a need for any stronger rate hikes in the future or tightening on monetary policy. So that's why it's important and can have a big effect. And as said earlier as well, it may influence other central banks to follow in a similar rate path as well. So if you see the central bank or the Fed hiking by 50 basis points or looking to hike by more or start to tighten their monetary policy, other central banks, what we've already seen with the Bank of Canada, who were the first ones to hike by 50 basis points, then that could also have an influence on them and other central banks globally as well. So how does it affect the market? So this is where it can be very tricky to gauge what the markets are doing. But usually in normal circumstances, the currency with the dollar, it might rally if the Fed is showing an inclination to raise interest rates. How much the dollar move depends on the FX market and whether it's been taken into account, if hikes have been taken into account. And if they've taken to consideration, the dollar movement may be minimal, i.e., if if the movement or the hike is expected at a certain amount, then the reaction might be minimal. Stocks, so the relationship between stock prices and the Fed funds rate is quite direct. When rates rise or are hinted that they will be, high rates tend to dampen, high rates are there to dampen inflation pressures or to bring them in under control. But the rate hikes also increase the cost of doing business and could cut profit margins. So the higher the rate hike, the more borrowing, or the increased in amounts of paying to borrow that money or those loans would make it harder for those businesses to be able to get strong profits or stronger profits. And usually for bonds as well, so investors might flee to the long bonds if rates rise, as it could confirm that inflation is on the rise, and they may instead chase shorter term securities. As the sale of bonds accelerates, their yields will rise, and once investors grow confident that monetary policy is working and inflation appears to be steady, they usually switch to buying bonds again to lock in the highest yield possible. So I've already got some comments coming through. You've got Scott Sommer saying the current expectation is a 50 base point increase. Got David Sini saying 0.75% with a question mark. And Scott Sommer saying current SPX expected moving options that expire in 3 hours is roughly 53 points. Yeah, so we'll go through the rate expectations pretty soon and kind of explain what to expect. So where is the economy at the moment? So you have GDP that contracted to minus 1.4%, the first time since 2020. Mainly it was due to an import surge, a lot of buying from US consumers of goods and services. Inflation at a 40-year high at 8.5%. And if we keep going along, PC price index year on year at 6.6%, and the personal consumption for the first quarter at 2.7 versus Q4 21 at 2.5, and the consumer spending in March, or the report that we had last month, we had March coming in at 1.1% versus a prior of 0.6%. Non-farm payrolls as well, which we've of course going to have this Friday. The actual was 431k versus the prior of 678k. So although there were jobs being added, not as strong as the prior month. ISM, the manufacturing PMI, showing the 22nd consecutive rise. From the data that we had there. Okay. So the prior was 57.1, and the new figure came in at 55.4. University of Michigan sentiment final, which was 65.2 versus the prior of 59.4, and this will be the first half-point hike in almost 22 years that is expected for today as well. And also the yield on Monday, the 10-year yield briefly touched 3%, which was the first time since 2018. So so remember with bonds, when rates are raised, usually for bond traders, they would want to flee their current bond that they have and go in favor of a higher returning bond. So hence we'd seen the yield seeing that increase by quite a bit. So as I said, touching 3% for the first time since 2018. And there's been a lot of pressure in the bond market as well. And we'll touch on that a bit later on. So the previous FOMC meeting then, so hikes signaled at the upcoming meetings. The last rate decision that we had, there was an 8-1 vote to lift the key rate by 25 basis points. Bullard wanted a 50 basis point hike. You also had the Ukraine invasion, which they said was likely to create additional upward pressure on inflation and weigh on economic activity in the near term. The median dot plot saw the rate at 1.9% and 2.8% in 2023. Also, the Fed stated that it would begin letting its $8.9 trillion balance sheet shrink at the coming meeting, but no further details were provided. Of course, we got that in the minutes later on, or in April, where they did decide to reduce their balance sheet by $95 billion per month. So you had Powell saying that the economy is very strong and well positioned to handle tighter monetary policy. So also a reminder as well that the Fed had previously held off on hiking rates because officials believed that inflation shock would diminish once the economy recovered from the pandemic recession and lockdowns, though they were also wary of new COVID-19 variants and statistics showing a bumpy jobs recovery. Instead, price increases intensified as a result of a combination of enormous government stimulus, tightening labor markets, increasing commodity costs, and fraying supply chains. And Powell had also been working with Fed policy framework that was set in mid-2020 to allow for modest above target inflation in the intention of widening employment. Of course, that's way above their target of 2%, okay, which a lot of the other central banks quote as well, 2% being their target range for inflation. As said, inflation at the moment in the US at 8.5%, so well above their target range. So hence, there are talks of stronger rate hikes. Maybe there could be a 75 basis point hike, but stronger action being taken by the Federal Reserve of looking for a 50 basis point hike at this meeting. So the balance sheet reduction then. So the minutes revealed as a $95 billion reduction. And to break that up, you have so they're going to be selling $60 billion in treasuries or government debt, and then $35 billion in mortgage-backed securities. So this is the summary then of the balance sheet in its entirety, just an image from the Financial Times sourcing the Fed and Bloomberg. So we can see here, if we're of course considering the recession back in 07 to 09, you'd seen an increase in the balance sheet there to about 2 trillion. And then slowly increases, and then it starts, that's where we see the balance sheet runoff. And then we peaked around there at around 4 trillion. There was a slow decline there. Again, you had the rate decision that came first, and then you had the balance sheet runoff. And then in the COVID pandemic, where a lot of money was needed, of course, to fund the government, and then, of course, people who weren't able to pay back or weren't able to pay back their mortgages, or there were going to be more defaults expected on mortgages, then you had seen this meteoric rise or quick rise in the Fed's balance sheet to around $7 trillion of what we can see there, and then to this high point of nearly $9 trillion or $9 trillion in total. Now, of course, that's quite a lot of money that has been added into or funded into the economy via the Federal Reserve through those treasuries and mortgage-backed securities. The only issue for them is knowing how quickly to remove that support. If they decide to be very aggressive and remove that support quickly, that could lead into a situation for one, the government, where they lose that amount of funding through government securities quite quickly, and could lead to issues with funding other services and buying of goods that the government can do, and also providing people with jobless claims money as well. So that's one implication. And then, of course, for those who have got a house or a mortgage as well, if you withdraw that quite quickly or at a stronger rate, then again that could cause recession, let's say, indicators or expectations to rise if the Federal Reserve is quicker in their tightening of monetary policy. So that's one of the things that, of course, as said, not only is the Federal Reserve on a tightrope at the moment of how to act, or how quickly or how slowly to act to not only, first of all, control inflation and slow down economic growth, but also to make sure that there isn't that no recession is caused as well. And then with the hikes and the traders betting, so this has been quite a seesaw, not only with the Federal Reserve, but the ECB, the Bank of England, where traders have increased their bets for central bank tightening. And as we can see here, so last year, December 31st, where we can see where the rates would be compared to last year and compared to April the 6th, you've seen a huge or a rise in expectations for rate hikes, to the point where initially, if we're thinking about January 2023, where they expect the rate to be around 0.75%, now traders are seeing that the rate could reach 2.5%. So one thing you've got to understand too is that the Federal Reserve has a neutral rate, where the neutral rate is where the central bank believes that will be enough to control inflation, but also not too damaging to the economy to cause a recession. So a lot of talk has been made by central bankers from the FOMC, looking at a range of 2.4% to 2.5%, or between 2% to 2.5%, as to see where the neutral rate can be. So I think once we reach the target, or once we reach the neutral rate, then we will have to see whether or not the Federal Reserve decides to take any further action to rein in inflation if it's still not under control. And that could mean for the stock market, that could be even worse if the central bank has to be tighter with their monetary policy to rein in inflation. Then if we have a look further, so Powell and his Ukraine focus. Now, before March 16th, he'd mentioned that there was a risk of a EU recession, and US growth could drag by 0.3% or 1% in a severe recession. So again, with the prices of energy having an impact on inflation readings that we've seen previously with the US, particularly the EU, that is, of course, if energy prices rise, not only does that mean that consumers have to pay more for let's say retail fuel or natural gas to heat their homes, but also for businesses too that rely on transporting their goods or using, let's say, crude to make plastic goods or products, or to provide services in order to make a profit. But if prices are increasing, then that makes it slightly harder for those businesses to be able to attain that, and it could mean that they actually reap less of the profits that they could have gained without a price or energy crisis. So geopolitical uncertainties. Okay, so you have the risk of the EU recession and what that could do to US growth. Okay, and then we have geopolitical uncertainties of where we have the Federal Reserve that had their index created, which showed that the risk was no higher than those in 1991 Gulf War, and it could be a 0.5% drag on the economy. So this Ukraine crisis or the Ukraine conflict, if it continues to drag on, then there could be a 0.5% drag on the economy itself. Then at the FOMC, or the last meeting that we had we had that the Powell said that the immediate implications of the conflict will put additional upward pressure on near-term inflation here at home. So as I've already said, with consumers having to pay for higher energy bills and also for businesses as well. Then the Fed voting members. So we had Fed's Mester, who said that it will take she thought it will take a couple of years to get inflation down to 2%, and once rates are at neutral, they could pause or raise further depending on the data. So not only are we looking at inflation data, but we're also looking at wages as well, and how much what the average hourly wage is. So I'll just show this. So this is an index that the Fed has created themselves for determining risk to the US economy. Then April 14th, you had Fed's William saying that talking on the balance sheet that he expects that start in June if they make a decision in May. And the pace of rate hikes depends on the economy's direction, but 50 basis points at the next meeting is a feasible option. Also remind as well, going slightly back, you had Fed's Mester saying that the shock of a 75 basis point rate hike isn't needed, but she supports a 50 basis point hike in this meeting in May. Fed's Brainard saying the Fed would methodically tighten monetary policy through a series of rate hikes, beginning to decrease the balance sheet at a rapid pace as soon as the May meeting. So that comment there of Brainard before the minutes, or a couple of days before the minutes were released, that had caused a depreciation or a risk-off reaction where the US indexes had seen a depreciation in value and the dollar had seen an appreciation. So non-voting Fed members, you had on April 19th, so you had Fed's Bostic saying that cut to global growth is a sign that the Fed should be careful and is a reason not to go beyond neutral. And any action is possible that are larger than the larger 75 basis point hike is not on the radar. So again, that being affirmed there by another central banker, that 75 basis point hike isn't on the table. On March 24th, you had Kashkari saying that there was a risk of overdoing it on rate hikes, and Daly saying that increasing to 2.5% this year is not abrupt or shocking. And as we'd seen, you had from the FT, you'd seen that traders were betting on the rate to reach 2.5% by 2023. But of course, that could mean we could get to that point much sooner with these hikes. And also sees a case for a 50 basis point hike in May is complete, so supporting that there for a 50 basis point hike today. Investment bank views as well. So you have BlackRock saying the markets are befuddled and that the uncertainty factor is among the biggest that they've seen in recent years, according to Kate Moore, who's the head of the thematic strategy at BlackRock Global Allocation Team. And she added that inflation, COVID, central bank policy, and the Ukrainian war are all referenced, and that there are a lot of cross currents. And against a backdrop, it's difficult to imagine volatility falling that much. So what she means is that, of course, with the expectation of rate hikes coming through, then that means with the expectation of rate hikes coming through and being increased, and traders increasing their bets here and there of how much the Fed could raise rates, is causing quite huge moves in the markets, and is driving a lot of the sentiment that we've seen recently. 25th, of course, so if we're looking at the rates as well, so you had flight safety and lower treasury yields, which drove the 10-year yield down to 2.817% from 2.905% on Friday. And as the Ukrainian crisis continues, our markets worry about the potential ramifications of the Fed's struggle against inflation. Wells Fargo says that a hawkish FOMC is expected to raise rates by 50 basis points and again in June while shrinking the balance sheet. And they say that in their opinion, the risk that the committee shocks the market with a 75 basis point rate hike, even though this is not our base case scenario estimate, is considerably stronger than a 25 basis point surprise increase. And then Nomura. So this is where it gets a bit more interesting then. And I guess while we see some traders looking at not a lot of traders compared to a 50 basis point hike, but some traders are looking at 70 basis point hike. And could that be a possibility? So you have Nomura saying that the Fed is expected to hike rates by 50 basis points at today's meeting. But then they say they will, this is a comment that they made last week, is that they see 75 basis points both in June and July. They previously saw 50 basis point hikes, which of course is quite interesting that you have a lot of the US investment banks aren't seeing a 75 basis point hike. They're seeing a 50 basis point hike scenario. Okay. But just one thing that was of interest that I'd picked up on while doing some research is that Nomura was the only one or the only investment bank that I'd seen that was saying that there could be a 75 basis point hike in June and July. So what does that mean for further rate expectations? Well, they see that the hikes will take the Fed funds rate to 2.5% to 2.25% to 2.5% by July, which is around the FOMC's estimates of neutral. Remember I said between 2% to 2.5% is the neutral rate that's been thrown around by the different central bankers at the FOMC. So again, that's just one piece that I thought was quite interesting to share with you guys of further rate hike expectations and what that could do for the markets. If traders start to bet a 75 basis point hike for the future meetings, then that could mean that there's further downward pressure on the S&P 500 to price in that expected move if traders start betting on a 75 basis point hike. Commerzbank saying in regards to gold and the movements as well, that financial investors have been retreating from gold. And Briesman's view is that the markets have been focused on central bank tightening this week. So again, of course, if we're thinking about intermarket correlation, usually when the dollar appreciates in normal circumstances, then gold would see a depreciation, so more in favor of cash rather than the tangible asset. Instead, if cash is worth more with these rate hike expectations. JP Morgan saying that the Fed should have been quicker. So this was actually some stuff that was said. Some of it was said today and some of it early in the week. But they say that the Fed was a little late. So they see a 1/3 chance for a soft landing or 1/3 chance of a mild recession occurring in the US. Then Guggenheim Chief Investment Officer Minard, who said today, or actually in an interview a couple of days ago, said that the bond market bull trend is coming to an end as the Fed raises rates to fight inflation, which could mean rates go higher for a generation, and saying that a continuation of rate hikes will lead to a recession rather than letting the markets dictate. The key point to note is that last year he said that rates could turn negative in 2022, but of course that's not the case. That's been put out the window with the rate hike. That's already happened, and there wasn't even a thought of that this year at all. But just an updated view from Guggenheim's Minard in regards to that there. So when Minard was talking about the 30-year, that's not clear, but hopefully you can see that all right. They're representing the 30-year bond price you've seen since 1984. You've seen this huge move or huge appreciation in bond prices overall. A lot of that, of course, is to do with the risk that the US has faced, and also traders and investors protect themselves from geopolitical risks as well, other than the economy. So Guggenheimer, he said that the 40-year bond bull run, as I said earlier, he sees that coming to an end with these rate hikes coming in quick and fast. And of course, that's been evident with the bond, with the yields that we've seen rising rising quite quickly. Okay. So we've got about 30 minutes of this here, or before we get the decision. So other central banks. Okay, not only do we have to focus on what the Federal Reserve is doing and how that's impacted the dollar, but if we're looking at specific currency pairs like the dollar yen or the euro dollar, that's something that we've got to understand too. But I think the key focus is what the Bank of Japan has been doing recently and how that's affected the yen. So the yen, since the yen plunged more than 1% after the Bank of Japan, but this is past, of course, after the Bank of Japan said it will buy an unlimited amount of bonds every day at a fixed rate, hold down its yield target, and that move spread widespread sales of other currencies against the dollar. So this big old move from the Bank of Japan, they've been easing their monetary policy for a very long time. And through this easing of monetary policy to keep the rate low, to try and drive growth, particularly through the COVID pandemic when it was needed to try and help, try and bring back inflation and also to bring back growth. This has caused an overall depreciation in the Japanese yen, if we're looking at it compared to the dollar, from what we've seen. So since that bit of news had come out that they're going to be buying an unlimited amount of bonds every day and continuing to ease, whereas the Federal Reserve is in the mode of tightening monetary policy, the dollar has been seen as more has increased or has appreciated in its value compared to the Japanese yen, where it's seen a depreciation. So could that mean for the dollar yen, we could see a stronger reaction in the markets, even though the rate hike is expected and we may only get a modest move? That could be one scenario for the yen. But recently, I think one thing we've also got to understand too is when we're talking about the yen's weakness, when we do get economic releases or when they come out. If I go back to some of the other releases, other prior releases, so if we're looking at a consumer spending that we had, if I just bring that, yeah. So if we look at consumer spending, let me just bring that across. So the last report we'd seen about on the dollar yen, we'd seen about 18.5 pip move towards the upside, whereas the other currencies, or the other currency pairs, didn't see as strong a reaction compared to the dollar yen. Okay, if we look at some of the other ones too, go back to retail sales. Let's see some of the other recent ones that we've covered. ISM. So again here with the ISM, a report that we had last week. The report that we had this week on Monday. We'd seen a stronger move on the dollar yen compared to the other currency pairs when data was worse than expected. So we've seen about 19 pips down. So there's a stronger move there. Dollar CAD about 10 and cable about 9.5, and similarly to the other ones too. So, and then just some other comments on that there then. You have, so CBA, or the Commonwealth Bank of Australia, you had Clifton, who said that, or what she sees is that she says that the sharp monetary policy divergence between Japan and the US and Japan's shrinking current balance surplus support the dollar yen. Okay, so again, there's the affirmation that the yen is weaker against the dollar, according to economist at CBA Clifton. Also, then when we're looking at the dollar yen, going back to April 28th, but just a nice history of the dollar yen's move. So you have running with the bulls, or Bloomberg's nice chart that bar chart that they've got here, a nice chart that they have here. The dollar yen breached 130 after the Bank Japan weighed on the yield curve that they have. So there was, as you can see, so of course spot price being the white there for the Japanese yen, seeing that there was a more or less there was a depreciation in the Japanese yen and an appreciation on the dollar for there. So that, again, just another bit to consider, that we could that there might be a stronger move on the dollar yen, but that's we're yet to see what happens today. If we do get a very, very strong move at all. Now, one other thing that I wanted to cover as well, if we're looking at inflation and how we see what sort of divergence or difference that there is when we're focusing on inflation for different central banks. So in Europe, the main cause, of course, and that's evident not only through the inflation reading, but also geopolitical risks as well. Energy is the bigger, or the biggest factor that's been weighing in on the ECB and inflation. And then if we're looking at the UK or the Bank of England, you can see that their main focus is kind of been split with core goods and energy and a bit of food. And then in the US, services has been the bigger focus. But of course, you have energy as well. So more or less, energy and services are very similar. There's not really too much of a difference between the weight that it has on the inflation readings and the reports. And then core goods being the least or the smallest concentration in the CPI reports or inflation reports that we've seen. Okay, so of course back in January 21st, but that's what we've seen so far. Alrighty, now, apologies. So now the probabilities of rate hikes. So this is something that I think David's seen, or this is what we're going to be talking about now. Just to give a heads up, this part here of a potential for a 75 basis point hike has been changed again to where that's not that's not a possibility, whether there isn't a possibility or a chance of a 75 basis point hike. But overall, there's near enough a 99% chance that the Fed is going to raise their rates by 50 basis points. So the new target range of being 75 to 100 basis points, and of course current range being 0.25 to 0.50. So a 99% chance there of the Fed raising their rates today by 50 basis points, and then a 0.9% chance of that being a 75 basis point hike to 1.25% being the new high of the new range. So let me show you the current one then. See what we can currently see. Oh, okay. All right. So this is chopped and changed. So earlier on, as said, this was at 0%, and there was a 0.2% chance of a 25 base point hike. But then, so we're chopping and changing, but overall, the expectation is for a 50 base point hike from the Federal Reserve. This is going to be the devil of the stock market. It's if we do get a 75 base points hike from the Federal Reserve today, or a stronger move, then what that could mean for the currency is that we could see a stronger reaction from the dollar overall, and we don't get that modest reaction from a priced-in interest rate hike. And that could also mean for the stock market and stock indexes that we could see that move towards the downside and see a stronger depreciation in the stock market. So as said earlier on, when rates are raised, stock market doesn't like that. Of course, as said, it means that less profits, and it means an increase in borrowing prices or borrowing costs for businesses. So if we do get a 75 base point hike, something has gone completely wrong, where the central bank realizes that maybe inflation has got too out of control for them, where they need to take stronger action, or maybe the job market is even tighter than they expected it to be between the previous meeting and until now. So for the stock market, it could be more negative, and also we've also got to think about the bond market too. As I already mentioned, for the bond market, if I bring up the deviations of what we've seen. So with the last rate hike, when the rate was as expected, and it came in at 0.5, we'd seen about 30 ticks towards the downside on the bond price of the 2-year, and about 8 ticks down on the 30-year bond as well. So again, as said, when rates are raised or we're in the hiking cycle, bond traders would usually try and go for a higher yielding bond yield in favor of the old bond, which has been blown out by higher interest rates. So in this scenario, previously what we've seen, then that could mean we could see a stronger reaction or stronger depreciation in bond prices if we do get a 75 base point hike. And also, whilst I'm here as well, I might as well go through the other reactions from the market. So we've seen the S&P 500 see about 61 ticks for the downside, NASDAQ about 241 ticks. Bearing in mind, as said, it was already priced in, but we still had a strong reaction, a decent reaction from the market. Gold had finished its candle about 7 ticks down, but when the rate had been released or put out, initially we'd seen about 70 ticks towards the downside, and 37 ticks towards the upside. So there's one thing to take away from that is that there's going to be a lot more choppiness in gold compared to the other asset classes and currencies, or the bond market, or the stock indexes, or the stock market. But that's what gold did last time. Again, still finished 7 ticks down. Dollar yen, 25.5 pips towards the upside, as did the euro dollar. Cable, 25 pips. So, excuse me, euro dollar had seen about 25.5 pips down, and cable had seen about 25 pips down. Dollar CAD, about 19.5 pips up. Dollar yen, dollar Swiss franc had seen about 15 pips up. And the New Zealand dollar has seen about 15 pips down, and the Aussie dollar has seen about 20 pips down. So the biggest movers in the currency market were the dollar yen, the euro dollar, and cable, and also you had the Aussie dollar, or near enough, close enough to the dollar CAD. And then if we're looking at the tick sizes as well in the treasury on the bond market, we've seen the 2-year had seen a bigger appreciation. Of course, the Federal Reserve controls short-term rates. Okay, so usually you'd expect short-term rates to see a bigger appreciation. Usually, when we're in this current hiking phase. Oh, is the mic cracking? That might be my voice. If it's crackling, I apologize. Hopefully, it should be clear. Oh, yes, it is crackling. Okay, is that okay? Should be okay. Ooh, that is very, very crackly. Is that better? Let me know if it is a little bit better. Oops. Hold on. Okay, is that better? I could hear myself. That sounds a little bit better. Apologies for that. Oh, still crackly. Okay. 1 second, guys. You might hear a little pop. Okay, how's that? Hopefully that's fixed it. Yay, I can hear myself clearly. All right. Ha! Okay, awesome. This noise occurs whenever you make a speech. Maybe it's telling me to shut up. Stop talking. We've got about 12 minutes. Well, okay, everything's all sounding fine. Apologies for that. Thank you for letting me know. Alrighty. Okay, so as I was saying, let's get back to it then. So today what could happen if we've seen past reactions from the dollar yen, whether there was a strong reaction on US releases in the dollar yen, we could see that a stronger reaction on that currency pair there. And as said, what we've recently seen on the Monday with the ISO manufacturing report as well. But again, we're yet to see what could actually happen, whether we do see that happening. So let's get to I think what I want to do now is show the prior release as well and what had occurred. So again, just going through some of the previous what are the expectations for the interest rate decision today. Again, this is what we'd seen earlier, but now is more or less the same. Okay, so the market reactions then. So let's bring that up. So this just a quick snapshot. We've seen the S&P 500 see move towards the downside. Again, expectation was for that hike there of 25 basis points. So you didn't see a strong initial reaction from the markets, but overall then it continued its movement towards the downside. And then if we're looking at the dollar yen, again, similarly, not a very strong reaction as it was priced in, but still seeing that 25.5 pip move towards the upside. Gold, as you can see there, was very mixed in its reaction. As said, there was 70 ticks towards the downside and then 35 ticks towards the upside, and finished down about 7 ticks down. But more choppy on the market, or on the gold market there. And if we're looking at the yield here as well, if we're taking a look at the 2-year yield, we'd seen about 30 ticks towards the downside, over 30 ticks towards downside, or the entire movement going from the start of the candle to the bottom of the candle, or to the wick, and then it continued. The bond price continued to move towards the downside. Whereas we can see, if we're comparing to the other asset classes, you'd seen a reversal started to occur at around half 2, or during the press conference of Fed's Powell. All right, so it's time to have a look at the video then of the release. Of course, that's a good way to kind of gauge what's happening, or what happened. It's always nice to see. Sound is still good. All right, I'm going to shut up now. Okay. That's about less than 10 seconds before the release, and there we go. Hike as expected. So the dollar yen moved towards the upside there. The S&P moved towards the downside. And that's the 2-year bond. That's the 30-year bond. So overall, what you need to know is that there was a strengthening of the dollar overall in the markets. Even though it was the reaction, there was a strong reaction. It was still quite modest if we're looking at the S&P 500 and how that reacted in the markets, or where the candle had finished. Okay, so keep going across. Let's see what else we have. The dollar yen nearly erased its initial appreciation, went nearly back down towards its pre-trading level. Whereas on the S&P, even though it did see that reversal after about a couple of minutes, it wasn't a complete. There wasn't a completion of that reversal, so it's still headed towards the downside. And as you've seen on the image that I'd shown, it continued for about half an hour, or from what we'd seen previously. And skip across. Look what else we've got coming through. Again, inflation just some of the headlines that we can see coming through. Inflation expectations being raised to 4.3% in 2022 and 2.7% in 2023. Keep going. Euro dollar. So actually, that's one thing, interesting thing I wanted to just check. So cable had reversed its initial decline, and then if we look at the euro dollar, and then on the euro dollar, same thing as well. So after about a couple of minutes, it reversed its initial decline, and then moved back towards the downside. Okay, we've got about 5 minutes until the release. Butterfly Spread says OMG, OMG, I'm about to blow my account on the FOMC. All right, well, good luck to you. That's all I can say. Please don't. I don't like seeing that happen. Okay, so that's probably all we need to see then from there. Now, sometimes what could okay, so that's basically the presentation right there. We've got about, I said, 5 minutes. Let's get actually, I want to see that change. That's still the same. Oh, okay. Wow. Okay, so that went from that went from 0.9% chance of a 75 base point hike to 2.1%. Ooh, all fun. Interesting. Anyway, so let's get Tick Strike open. So I think we'll do a quick little promo. So Financial Juice. So Financial Juice, of course, if you want to stay up to date with what's going on in the markets and get real-time news and voice 24/7, then Financial Juice is the place to be. What a lot of traders do is they use it to manage their risks, manage their risk in the market, manage their trades. But we've had headlines from earlier on today, which is a great example of why a Squawk service or a voice tech and text service is quite key. Is when you had von der Leyen talking about phasing out Russian supply of crude oil within the next 6 months, you'd seen that you'd seen an instant pop on WTI crude oil off of the back of that there, and we'd seen a continuation of that where we'd seen about crude or WTI up about 2.7% off of the back of that there. But Financial Juice is a key, is something that investment banks also use for themselves as well. Of course, staying ahead of what the market is, or what the governments and the geopolitical risks helps them in their trading, and they use it. And they use that there. And then, of course, so I'll put in the link for you. We have a 7-day free trial at the moment of Financial Juice Pro, which you can follow here. That's the link there. Also, if you like the content that we've been putting out for you in Macro Race, and if you found it useful, I hope you guys found it useful. Feel free to tell me if you didn't. Then you can sign up to our mailing list here. Oh, that's all. Follow us on Twitter. Let me get our. You can sign up to our mailing list if I just grab it here. Okay, we haven't got too long left for the release. I'll do it quickly here. There we go. So Galaxy One, I just pulled that from Bloomberg's site. That little graph or the bar chart that I pulled. If you're wondering where that came from, just on one of their articles that they had. But yes, so the macro race, if you want to join our mailing list and you like what we've done here today, then great, go for it. We've got less than a minute now till the rate decision. Then you can follow us and join up on that there. If you like the video, don't forget to like and share this video with your other peeps. And then also subscribe to our channel too to stay up to date. Yeah, there's about 134 people. Hell yeah. All right. 30 or just over 30 seconds from what I can see here. Alrighty. So we've got the S&P, we've got the dollar yen, we got our gold, and we just need our 2-year. All right. We'll keep an eye on that there. 10 seconds. 10 seconds, ladies and gents. Okay, 50 base point hike, 50 base point hike in line with the expectation or as expected. Seeing the dollar yen did see some movement towards the upside. S&P saw and wow, initial little jump and some move towards the downside. Gold a bit mixed here, bit choppy. Now seeing some move towards the downside. There we go. Woohoo! Dollar yen going up and up and up on the expected rate hike. S&P mixed. 2-year yield or 2-year bond price seeing some movement towards the upside. Okay, now we're seeing the reversal on the dollar yen. I want to see what's being said actually. That's going to be quite key from okay, what do we have here? I think it just came out twice. Financial news feed. Okay, let's have a little read through. Treasury holdings. So, after 3 months, monthly capital balance sheet reductions will rise to 60 billion for treasuries and 35 billion for MBS. So that's nothing new there. That's as expected. Fed will begin trimming balance sheet on June 1st. Okay. Trying to see what's causing some downside movement on the dollar now, or the dollar yen now. Implications for US economy highly uncertain, but a near-term invasion and related events are likely to create additional upward pressure. Okay. Upward pressure on inflation and weigh on economic activity. Invasion of Ukraine by Russia is causing tremendous human and economic hardship. There's nothing. Okay, so the vote was unanimous for a 50 basis point hike. What are we seeing? Okay, oof, this is okay, let's look at some of the other currency pairs too. Let's get our Euro, USD. All right. So Euro dollar, seeing move towards the upside there. Let's have a little look. GBP, USD. Okay, so nothing else new or outstanding from the Federal Reserve other than the expected rate hike. So I guess what we're seeing here is the rate hike has come in as expected from what the markets were expecting. So you'd seen that initial appreciation on the dollar yen from the dollar, and then there isn't anything. They've confirmed that they're going to be reducing their balance sheet. But nothing else in regards to rate expectations or anything else to do with inflation that's completely new or completely different or surprising to the market. So I think that's why we've seen that reversal on the quick reversal on the dollar and more of an appreciation on the other currency pairs. So yeah, it was a bigger move on the dollar yen. Was what I expected, considering how the other releases have reacted. Okay, let's start doing some measuring. Actually, I want to have a look at the other currency pairs too. ED, dollar. Okay, that's up. Let's look at NZD, USD. That's probably also going to be up too. Yeah, that is up. All right, what else do we see? Okay, so I'll measure this initial move towards the upside then on the dollar yen. It's about 17 pips towards the upside initially, and then let's do another little measurement. The candle started and we're finished. And then about 13.5 pips towards the downside. Let's see what these comments that are coming through. I think there's a load of them here. Saturday's Mountain said, hey, are you the voice that comes in the financial juice? It is not me. I think that is James who said the release. Saturday's Mountain said, I cannot understand the direction of markets. I think that's kind of been explained by someone else. So here. Gold seems upward. USD seems some downside. Just running. Team is saying they're just running stops. Scotch and Stock saying, I think this will create certainty in the markets, making them go up. There is too much FUD in the markets, thinking that we could see 75 basis points. The 50 basis point was priced in. I'm waiting for the balance sheet at the press conference. I don't know. I'm going to trade after the market decides the direction. Life around Brian says, any comments for the market 50 basis point hike, please? Yes. So I think we've I think what I said, I think what some people have already said too is that the move was the 50 basis point hike was priced in. So we did see initial move towards the downside, but nothing from the statement was out of the ordinary or completely new or unexpected. So I think that's one of the reasons why we're seeing that quick reversal and a move towards the upside there. I'm also just going to go back through that report there, or the statement, to see if there is anything that's supporting, other than it being priced in, to see why we'd seen that move towards the upside. I don't really see anything from it. No. Is the answer. There isn't anything else. More just it being priced in from what we've seen. But yeah, as somebody already said, who said that there. Yeah, actually, let's have a look at some of the other places. So that's there we go. The S&P is down. So I was looking at gold there. At the S&P, let's look at NQ. Let's see. That's down. ZT, that's 2 year. Let's do the ZB, or the 30 year. I don't expect the 30 year to be as strong as a move compared to the 2 year. Remember, short term rates where there's a stronger move. Yeah, okay. We put that together actually. Right, let's have a look. Okay. So the S&P. If I just grab what the initial move was. Okay, so that's about 46 ticks was the downside, and then it's quite quick, very quick reaction. The candle finished about 28 ticks up, and then let's see what this. Let's go. Let's start. Whoa! Whoops. What do I want to do? Go from the start of the candle to the top. Okay, and then about. So after that initial move towards the downside, about 48 ticks towards the upside to the wick of that candle, and then as I said, finished around 28 ticks up. Okay, now let's see where we are. We are. So we close down. About we were to the point where we were there. About 66 ticks down. Move that back to where we currently are. We're on there. About 18 ticks down. 18 ticks down. And there, gold. Let's see the we had here. about 28 ticks down, and then full move 55, 50, still up on gold. Right, let's look at the other currencies too. Euro dollar should move down. Whoops. About 9.5 pips down, or 10 pips down, and then go. That kind of finished up about 20 pips up. Okay, let's see. Cable about 5 pips down, and then 24.5 pips up, and then finished up about 23.5 pips. Initial candle, Aussie dollar, about 0.9, about 2 pips down, and then if we go back up, about 26 pips up, and then New Zealand dollar. Also, I want to check the crude oil market too, WTI, see what that did. 3 pips down, and then 20 pips up. So much measuring to do. Initial move was there, about 256 ticks down, and then to the top of that, about 177 ticks up, and then finished 106 ticks up. Wait now. Okay, still down 119 ticks. Moment. Just leave that all there for now. And ZB or 30 year. Three ticks down. And then 9 ticks up. Oops. Bit too much. What did I just see there? Interest rate futures suggest 94% probability of the Fed funds rate of at least 2.75% at the year end. So remember we looked at that, the FT piece, or their chart, bar chart, of showing traders looking for 2.5% in 2023. Now let's have a look at this. Let's give it a refresh. See what the Fed Watch tool is doing. Galaxy One says 76% for a 50 base point hike, the next hike, and then 24% chance of a 75 base point hike. This is, well, it's still loading. It's probably just want to go back to this. Okay, so Fed Watch see more than 200 base points of move, or 200 base points or more Fed tightening is priced into US rate futures in 2022, implying a Fed funds rate of 2.9% this year. I want to see what other, we didn't get any other rate expectations. Probably going to get that in the minutes of where Federal Reserve officials see how much they want to hike by. What they want to do, see the dot, or the vote was unanimous. But okay. No, that's what I wanted. Okay. Alrighty. Well, that's still loading up, but I think what Galaxy One said, if there's a 76% chance for a 50 base point hike next, that's what and the page ain't working. Great. Perfecto. Right. We'll see if there's anything else that kind of trickles through. All right, so more of a positive reaction from the bond market, the 2-year and the 30-year. So indexes still down. Of course, now looking to price in that 50 base point hike for the next meeting. What else we got here? Ooh, I've just seen that. Galaxy One said, whoever was waiting for a 25 base point hike or 25 base points needs to visit Arkham Asylum. Whoa, some strong words there. Well, I mean, it was. I mean, it wasn't really a possibility, but you never know what could have happened, and it didn't happen. So that was out of the picture. What else do we have? I've missed a lot of these comments. 3 kids and a dad. Oh, I don't know why I did that. We were waiting for something unexpected, like 25 or 75. Nasdaq is red. Butterfly spread says didn't blow my account. Made money with ES. Hikes were obviously priced in. Going along was the only option. Easy money. Yeah. Got some laughing faces, smileys. I think we'll see a 10 million. 10 around it before the speech. Airport Big says the issue is Fed is finally saying that more inflation is coming. And that's it, I think. Just trying to see if I missed out anything else. 3 kids and a dad said earlier that we'll see a 1 to 2 month rally and then a slide into a recession from a bubble pop. And this is before the release. Or was that? No, that was after the release. That was post release. Okay. All right. Who found that useful? Or what I do useful? I hope it was. I kind of just blabbed on for about an hour, making no sense. If you did find it useful, let me know. If there's anything that you want me to, or you didn't find useful, or you wanted me to add or talk about, then do hit me up at tony@financialjuice.com. And yeah, and let me know. You can email me with any questions or any thoughts that you have, anything you want me to work on. Remember, as said, we do have the free trial or 7-day free trial at the moment of Financial Juice Pro. So if you want to, as said, keep an eye on what's going on with headlines, geopolitical risks, what central bankers are saying, and how and maybe if markets are pricing in rate hikes for the future, then that's something. And Financial Juice is a place to do that and to stay up to date with what's going on. Also, as said, it's 24/7 or near enough 24/7, 24/5. We have this news service or Squawk service that we run. That's a link in the chat again. Of course, we've seen a load of different comments coming through, so it's probably been lost. But again, you can sign up for a 7-day free trial and try that out as well. Not only do you get real-time news with no adverts playing, no delays to the voice or text feed. But you can also add in triggers for economic releases here as well, which you can do manually on the financial site. So let's say I'm expecting, if I wanted to buy, let's say the Australian dollar, I would look for maybe, let's say, for the actual figure to come out at 20%, and to sell, I would look for the actual figure to come out at, let's say, minus 500. Okay. Mm-hmm. Oh, I know that. How did that go through on the chat? Don't want that coming through here. But yes, if you want to, and then you can save that, and then when the release comes out, it will, if it does meet your criteria of a buy, then it will flash up with a little sign saying buy in green, and if it's meets up on the other, if it meets your, if you want to sell and it meets the criteria, then it'll show up with a sell sign. So that's something that you can. I've got some images, well, not images, some comments coming through. Yeah, I don't know how those links got through. Somehow they made their way through here. Scotch and Stock says them bots. Caliph says is it all over? YouTube needs to do something about them. Yes, they do. Three kids and a dad says, can I buy options contracts on your webcams? And so going back to Ansari Udin. Yes, I have not forgotten your comment where you just asked about that on what happened in gold. So I think for what we've seen on the rest of the markets, the hike was priced in for a 50 basis point hike, and the statement didn't have anything new or fresh or unexpected in regards to inflation or reducing the balance sheet. A lot of that was said in the meeting minutes and when in regards to the balance sheet. So you'd seen, although it was priced in, you'd seen an initial decline on gold, but then it reversed that and moved back towards the upside. And no enough just basically forgot about the release or forgot about FOMC. Now we're waiting for the press conference, which is in about 8 minutes. That's going to be quite interesting to see whether or not, or what kind of how much of a divergence there is from Powell's comments to compare to the statement that's been released. But usually there isn't really. Powell probably is going to stick to the script. But again, you never know. There could be a surprise that the Powell could come through with. You never ever know. That's why I love this. That's why I love financial markets and the news that goes along with it too. All right, hopefully that's answered your questions. As I said, you've got my email there. You've got the link to the Financial Juice Pro 7-day free trial. Tick Strike 2. If you're watching Tick Strike, I should have been a bit more, but I think I was more focused on the reactions and the headlines. Tick Strike. If you want to have a 7-day free trial of Tick Strike and you're familiar with it but haven't had a chance to play with it, now's your chance to. Okay, so with Tick Strike, as we can see here, it lets you listen to order flow. So imagine you're in the trading pits. Let's say this market open and all the guys and gals start shouting, buy, 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 sell, 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 put it in their orders, buy, 22 or whatever. That sound or that you would hear in the pits has been translated visually and audibly via Tick Strike here. So you can of course see see how much strength there is or buying or selling that there is in the markets, or if there is a strong movement, let's say on the dollar yen, whether that's currently showing, no, that's the screen. You can see if there's any, see there, you can see a little bit of a tick towards the upside on the dollar yen and now towards the downside. But you can see which you can't. Of course, you can't predict which way the market's gonna go. But you can hear as to how much buying or selling there is, or if there's a lot of buying, if there's a lot of selling that's occurring in the market. Now, one of the other interesting features as well of tick strike is that you can change the level of sensitivity. I've got it on 1 at the moment, so I can see every pop, every little bit of movement towards the upside or downside. But if you don't want to see the visual aid, let's say, and you don't want to see it popping off too much, or you don't want to hear it go too much, then you can raise. Let's do it on the dollar yen actually. You can raise the level of sensitivity to higher, or as high as you want, to. So what you're basically looking for is you're looking for a higher amount of selling or more buying or selling in order for the ticker that you have here to set off. Okay, usually, of course, if there are bigger moves, that's going to mean that you're going to get a high number here, and that could mean that there are bigger moves happening in the markets in a certain direction. Usually that's going to happen in very volatile markets, like during the COVID pandemic. You'd seen a lot of selling happening because of people having to jump out of their positions because everyone else is selling, right? But yeah, so that's there for you to have a little look at. Don't forget to, again, if you liked what we've put out, follow us on Twitter as well, or Macroace. There we go. You can follow us there and kind of stay up to date with the links that I'll be putting out too for these live stream videos for you to be able to watch as well. I'm sorry, I think I did explain what happened to gold for you there. But if you have any other questions, like I said, you've got my email address if there's any other questions that you have about it. Okay. Rightio. So that has been, I think, no, one thing I did want to do is check on WTI. See what happened there. I did say I was going to have a look at it. Where are we? Okay, didn't see. Well, it's a bit choppy. In the crude oil market, somebody said Bitcoin. Somebody brought that up. Let me see. Let's see what's crypto. I think Bitcoin is going to be going. Whoops. Yeah, I think if it's against the dollar, Bitcoin's going to go down. It's a risky asset, very, very risky. Or everything is a risk. A risk has a risk with it. But Bitcoin, I'll bring it up here on the chart just because we asked about it. There we go. And that was at 2 o'clock. So it's seen a jump and a move down. Everyone's still down compared to still hasn't cleared its release level or prior release level yet. That's Bitcoin there for you. Alrighty. Thank you very much, ladies and gentlemen. Somebody said, why is the CME calculating 150 base point hike? There we go. I think it's going to work. Hey. All right, let me close tick strike. No. Not there. That's old, by the way. I don't think I can't see the new one at the moment. That's old. I cannot see that there. Okay. Rightio. a lot of it's probably because if you, like Nomura had said, if they're looking for a 75 basis point hike in June and July, and they were expecting a 50 basis point hike for May, it could be that that would more than likely be for expecting high rate hikes. I can't see anywhere at the moment on the CME looking at a 95% chance of a 150 basis point hike. That'd be nuts, very very nuts. But I think let's let the markets cool down a little bit, and let's kind of see what Powell says, which is starting now actually. And then yeah, okay, there we go. Okay, so swaps are losing faith in 75 basis point hike in June. For a June hike, giving up on bets in the wake of FOMC statement. That's according to a source. Oh wow, okay. Right. Okay, ladies and gents, inflation is too high. All right, so you can do anything more about it? We'll see what else he says. Anyway, thank you very much for joining me. I'm going to leave you now. Tomorrow, it's going to be quite another important day too for the markets. We have the Bank of England interest rate decision. Okay, seems like some of the inflation comments are jolting seeing an upside or a reversal of that initial move towards the downside and move towards the upside on the dollar yen. Let's see. Okay, gas is down now. Yeah, so I'll put in the. Let me put in the live link for the Bank of England for tomorrow for you here, seeing as you've kindly joined me today for the FOMC rate decision. Okay, and there we go. Okay, there it is for tomorrow for the Bank of England. Now I'll be starting that very early in the morning, or getting up bright and early in the morning for myself. But at 7 a.m. Eastern time, you have the rate decision. But we'll be starting at 6 a.m. Eastern time, again an hour before the release, to go through the Bank of England rate decision with you. Other than that, thank you very much. Take care. Good night. Enjoy Powell, and I'll see you tomorrow in the morning. Goodbye.